Good evening, everyone. We are live from Chicago. It's Thursday, May 9th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are really glad you're with us tonight. It's going to be a great show. An April pullback. Well, we had 3 great months, and then we down about 4.5% in April. What may happen in May? We're going to talk about that tonight. If you're new to the program, please click the subscribe button on YouTube. Click the little bell, and you'll be notified whenever we go live or whenever I upload a pre-recorded video. You can also find me on Facebook, X, and LinkedIn. I tweet almost every day, sometimes twice a day, and that'll increase in an election year. So hope you follow me there. Tell your friends too. This is our agenda for tonight. You guys know the squares. I tend to dim out the squares where I'm not going to talk about anything like the housing market and recession tonight, because we're nowhere near a recession and not much going on in housing actually as the summer months come in, but a lot to talk about. And A lot of questions to handle. You guys sent a boatload of questions in this last month. Those of you that aren't familiar with this, and you should be on our mailing list, you'll get an email Monday asking you to review the show if you want, or to submit questions for the June show. Hope that you will do that. All right, for the monthly market review, so there is this phrase, sell in May and go away. Well, why do they say that? Well, because somebody's looked at the data, and the reality is it is true. The annualized returns since 1950 on the S&P are better November through April than they are May through October, but that's not the entire picture. Okay, the secular bull market makes a difference. I think each May needs to be separately analyzed based on the current technical and sentiment conditions. The tendency is to be weaker from May to October, yet we're in an 11-year secular bull market. Does that matter? It absolutely matters. Returns in a secular bull market are much better than in an average year. November through April, 17%, May through October, 10.5%. So do you really want to go away during the period of May to October? 10.5 is a pretty good return. So we at CB3 will stay and not go away. So there you go. That's my take on sell in May and go away. Every year when we do the May show, I have a little different variety on that, but that's this year's. And I hope you stay with us throughout this. If you're an investor, you will, because we're not changing anything. In fact, if anything, we've gotten rid of some cash in both CG and DI. So what is causing the market to return to the upside here, very close to lifetime records? Well, the fact that we've had 18 consecutive sessions where the fear index is 39. So you would think, well, if the fear is 39, that means people won't be buying. Well, as traders, we tend to fade, word that you should be familiar with, fade what's happening in the retail environment. Okay, so we're often trading with other retail traders as a portfolio manager here. But when they're fearful, we're buying. That's why Warren Buffett says you want to buy when there's blood in the streets and you want to sell when there's euphoria. And there's a lot of truth to that. So here's the chart you guys see almost every show. And so the selling in April from 2 weeks ago was not fun. I get it. But the market wasn't even down 5%, which is traditionally, disclosed as a pullback. So a correction would be 10% and a bear market would be down 20%, but we're nowhere close to that. So last and this week's rebound has helped to alleviate some of this short-term loss pain. I hope you guys didn't have any pain really, because it wasn't much at all. We did raise cash in both CG and GI. DS is always fully invested, but there's been no damage whatsoever to the long-term chart. And if you lean in, all right, I'm doing it here. You can't see me because I'm off camera, but lean in and look at that little blip down there. You can see the blip in 2020, which is when I started these live programs, and the blip in 1987. But in the 100-year picture of the S&P 500, it's just nothing significant at all. And in fact, Wall Street's getting more bullish about the second quarter results. Now, we're in the first quarter results right now, and they're almost done. But soon, that means after June 30th and after the July 4th festivities, we'll be focusing on second quarter earnings, always looking backwards 90 days. So despite these fears, Wall Street's optimistic. Aggregate earnings estimates for the current quarter, all right, are about 0.7, despite that the S&P fell 4.2%. It's just a technical correction. You simply can't go up forever. In fact, we need pullbacks to consolidate, to be able to get into stocks that we really want to enter, but we don't want to pay lofty prices for. All right. So it's healthy to do that. May is off to a better start than usual. So nobody that I see is going away. What does this mean to us at CB3 Financial? It's business as usual, folks. Business as usual. No big deal. The S&P extended its winning streak to 4 days on Tuesday, 5 days yesterday, 6 days today. The Dow's on a 7-day winning record, winning up day. It's pretty good, 3.5% over that period of time. The largest 4-day gain was 4, now it's 5, since November. All right, the fact that the streak persevered, shrugging off, this is what's important, shrugging off significant stock losses from Nvidia, Tesla, and Microsoft. Why are those so important? Because they are Magnificent Seven stocks, all right? And we want the market to do well. It's not that we want the Mag 7 stocks not to do well. Of course we do, because they're 50% of our DS program, Discretionary Strategies program. But the reality is that if the market can do well, even when the Mag 7 or some of the Mag 7 stocks are not performing well, that means that the sentiment is expanding to include non-Mag 7 stocks, and that's a good thing. S&P companies are on track for a year-over-year earnings growth rate of 5% in the first quarter, according to FactSet. That's the highest since the second quarter of 2022, and 2022 was a really rough year for a lot of us portfolio managers. So we don't want to go back to that, but the fact that we're taking out a record that was set early that year, it was later that year that was the problem, that is also encouraging. So the revenue growth rate stands at 4.1, on course for a 14th consecutive quarterly gain. That's 14 quarters, and that means COVID is absolutely in the rearview mirror as it pertains to stock market performance. And that is good to see. So you just got to ignore, the high-profile AI disappointments. And those are those three stocks that I just mentioned. Obviously, Meta and Google and Nvidia are not included in that. It's been a good earnings season. And between the Fed and earnings, that's what drives the market. And we get to the Fed in the next section, of course. More than 80% of the S&P is reported, and they're largely showing there's just no reason to worry about any Fed Reserve rate moves. Got a long segment tonight on the Fed, not terribly long, but enough to just show you they really can't stop this market. They would love to simmer it down and not have it do so well. Why would they want that? Because when markets are doing well, it does tend to increase inflation, and that makes their job more difficult. Jay Powell and company don't want their job to be more difficult. Corporate America has become used to navigating this high interest rate environment, and it's learned how to do it well. That's a good thing. It really is. That's a good thing. Okay, so the bulk of U.S. companies, as I just said, have now reported they're showing profit growth increasing. Earnings per share for these companies is now up about 5.2 from a year earlier. So you see the little blue bar on the end. You can go back to 2020. You can see the downturns there for 3 straight quarters, and then a little blip there. And then in 2021, of course, the post-COVID earnings came in, and they were phenomenal because they had nothing positive to compare to the previous year. But we're still rising. And I will note that this is happening in a Democrat administration. For those of you that think we have to have, Republicans in office for the market to do well, that's just not played out these last 4 years or 3.5 years. It's the strongest growth in nearly 2 years, and that's a positive. Here's the revenue trend, and I put the little black lines in here so you can see, well, yeah, that's definitely positive moving. Maybe too, if you were to block off, I'm putting my hand there on that last, covering up that last black line, and somebody might say, well, it's getting above trend in 2021. We need to sell. It's getting too expensive. Well, look at what happened. Look at the steepness of that curve, and that's why I'm showing you this. I don't know when an up move is going to end. What I can tell you is on a down move, we're limiting our risk. And we've talked all about that. We're going to do more of it tonight. Actually, a pretty long section in the CB3 methodology tonight. But I don't want to try to guess where the upside is because I want those gains. All right. And this chart, and this isn't a stock chart, this is just showing you S&P 12-month forward revenue. And that's a pretty strong chart. If it goes parabolic, then you have to watch out a little bit, but it's still growing. So we're going to be in the market. We always end the segment with this chart. So with 397 of the S&P 500 companies having reported, the upside surprise this quarter is 8.4, about 8.5% bigger than the previous quarters, which were quite strong in themselves. So you can see the S&P, 77% are beating estimates. The mean is about 73%. Consumer staples, healthcare, technology at 89%. Communication services. We have some real strong sectors here that are contributing to the S&P beating its projections. And by the time we get to next month's show, you will see more of that as we finish the earnings for the first quarter. Pretty much all the earnings will be done by our next show in June, and we'll look back, and I think it's going to continue to be a strong quarter despite everything going on. All right, let me say hi here. Welcome. I said hi in the chat to Deb and Deb, our two Debs. All right, Keith, 56, yeah, exactly, 56 there on the dew point. Wouldn't that be awesome? You could just come visit anytime. Yeah. A little inside joke between Deb B and I. So that I got to go on camera for this. My childhood home is just a little bit inflation. We're going to cover inflation in a little bit, but this is just a fun data for free for you guys. So my mom and dad bought this house when I was born just for me. No, they just needed a little bit bigger place. They paid for this house in 1955, $10,000. In 1979, my brother and I and sister were all gone from the house. They sold the house for $235,000. About 10 years later, 15 years later, it sold for 700 something now. And my childhood friend here is letting me know that the house is now on the market for $1.5 million. 10,000, $1.5 million, all in my lifetime. That is inflation. All right, there you go. Steve, welcome. I think you're in Washington. You might be our first online viewer from state of Washington, but glad to have you here. So why is this important? And here's why. Policy is important because politics, which we all hate, I think we can safely say that, do lead to policy, and policy has personal impact, and personal impact also has portfolio impact. So what is happening around the country is starting to look like the summer of '68 to me. Again, some people that may remember when I played in a band in high school, we used to play this song by Crosby, Stills, Nash & Young, "Four Dead in Ohio," and it's looking like, I sure hope it doesn't get to that in this country right now. But these protests are a problem for the Democrat Party for sure, and probably for the Republican too, but it's definitely more so for the Democrats. So peaceful protest is protected speech in America, at least for the time being. And yet, not violence and not even egregious caper lash. And there it is, the word of the day. Not even egregious caper lash is a persuasive tool, no matter what these protesters think is in their best interest. I agree that the civil unrest is hurting the left more than it's hurting the right, but it's hurting America. It's taking our mind off what we do best, which is the engine of economic growth. There'll be more to talk about with other aspects of the political scene right now, but I thought this was interesting. This is a compendium that I follow of polls. I'm a little old, about 4 days old on this, but look at the difference, and you probably can't see all the numbers, but this is a horse race. This is 1% this way, 1% that way. It alternates between weeks. There's no one, neither of the two candidates. And of course, Kennedy is in there now and could alter some of this. But as we lead up to November, I have a feeling this is going to be just as close, and November 5th will be a really big day in America. So the Fed, as I mentioned earlier, two reasons that stocks tend to move. One is earnings and the other is Fed Reserve policy. So Jay Powell got ahead of his skis a little while ago when he took a semi-victory lap and openly discussed rate cuts earlier in 2024. Now, Wall Street, the street, hijacked the Powell pivot and erroneously saw as many as 7 rate cuts. I have seen this in print. We only have 8 Fed meetings. Not a little colloquial there. Don't drop the G. We only have 8 Fed meetings in the year. I'm sorry, when I get wound up, it gets that way. So how do you have 7 rate cuts? I don't know. But this is why you can't follow the news, guys. Watch our show. I'll be straight with you. I really will. It's just crazy. Almost everyone that I read has recently lowered their expectations for the number of rate cuts. All right. So Powell finally stated the obvious. The Fed will leave rates at the current rate as long as needed. Wow, that is so profound, Jay. It's so profound, all right? Then he states the Fed is not considering any rate increases. But, of course, he's not the only Fed governor. Fed New York President John Williams said, well, there's no real rush to lower interest rates. And that's part of the reason, folks, why April was so mercuric. If you wondered why, we were just up 300 points in the Dow one day and down 450 the next. The Fed has enormous influence, and it's not just Jay Powell, it's these other governors, and there are 12 of them, okay? You should know yours. All right, Atlanta serves South Florida, Minneapolis, of course, Chicago, Detroit, San Francisco. But Williams said monetary policy is in a good place. And when asked about the possibility of raising costs, he said, maybe. And then he added, it's certainly possible. Well, when that hits the wires, that's what makes the markets move. And it's too bad. I wish these Fed governors would just have their meeting 8 times a year and shut up. Sorry, no other way to say it. When they're not, but they get interviewed, they want to go on camera, and then they say something, and then they have to reel it back, just like a fishing line, reel it back, all right? And that's what has happened to both these guys. So this is just a little graph here I thought was interesting. Look at this is the stress level of investors, actually published by the Federal Reserve of Kansas City, another one of the 12 cities. So you can see the stress levels under the 0 level. Look where it was. GFC does not stand for Kentucky Fried Chicken. That's KFC. The Great Financial Crisis is what GFC is. And you can see the stress level was really high, and also high during the pandemic. Not quite as high during the regional banks, except for those. We actually have clients that are bank auditors, and they have to deal with this sort of thing. Welcome back to us, our client from there. And so we'll see as the tensions drop here, if the Fed picks up on that and realizes that sentiment, if they look at my economic indicators coming up in 2 segments, they're going to realize the consumer is on the back of their heels right now. All right. And the consumer is 67% of the economy, at least in the US. So it's important that we keep or help the consumer to keep themselves financially healthy. Okay. So the employment scenario, it was a nice report, wrong way, sorry, here we go. So the April non-farms payroll was worse than expected, and it was good news. That's a duh. So the April jobs report came in lighter, which means there were less jobs created than they expected, and yet there was some relief there, because if it's really strong, then the Fed's going to say, no, inflation's still rising. We got all kinds of new jobs being created, can't lower rates. Well, market participants want to see lower rates. So the economic environment does seem supportive of stocks, which is why we are close to fully invested in CG, and we are now back to being fully invested in GI. Okay, many of the stocks in there, let me just say it. Yeah, so many of the stocks in GI, and we'll talk about this in the last segment that I always cover, are larger, more well-heeled, trillion-dollar, multi-billion-dollar companies, and they can stand the volatile up and down, whereas when things start deteriorating in CG, even though we're beating the S&P, which you'll see by about 920 basis points, I do get out of the way when things start getting crazy, and it happened in April. So much of the bearish unwillingness to see the positive in our post-COVID economic recovery could be rooted in this ideological fealty to monetarism. That's a statement right out of the Fed's book, which is kind of gobbledygook, but that's their way of saying, look, we understand that you guys want to see lower rates, but we just can't do it because the preponderance of Americans are adversely affected with high inflation. So slower hiring boosts hopes of a late summer rate cut, and probably not any sooner than that. All right, added 175,000 jobs, and the unemployment rate ticked up to 3.9. Well, that's just not much at all. All right, there's your 175 in red. I highlighted that bar. You can see it's been positive. Again, don't necessarily have to have a Republican administration. We've had decent job numbers here all the way from 2022. And you can see the unemployment rate, even though it's ticked up just a little bit, the low of 1969, which I think was 2.96 or something like that, almost 3%. We've been cresting along there most of Biden's term, so that's just the reality on that. So on the the employment picture, it's strong. It could be stronger. We'll see what happens as we move into the autumn, but for the most part, I think we're in good shape there. So, all right, inflation. This is going to be a topic really until further notice. There's no way around this. Commodities, you guys know that I trade commodities. Part of the reason is I want to have an acute awareness of what's going on out there in the world, even though you guys don't trade raw commodities in your accounts, unless those of you that are trading spec op with me. But so commodities stronger than the S&P for the last several weeks. You can see the dark green line exceeding the light green line. Why do they make these charts and like pick red and blue or something? And then the futures prices, I mean, crude oil, obviously always going to be volatile. Gold, copper, not quite so much, but still pretty strong. So what does this mean? The April CPI, Consumer Price Index, was hot. It was hot in March. It was hot in Feb. So the path to reaching 2% inflation is facing resistance. Why is this important? Because the Fed has two mandates. One, to maintain, which they haven't done, a 2% core inflation rate. All right. And the second is to maximize jobs. Now, those two objectives work against each other. So they sort of hedge each other, if you will. We want to have lots and lots of job growth. But if we have that, we're going to have tons of inflation, which means the Fed raises interest rates and then people stop hiring. And that's how the back and forth works in the economy. And as the portfolio manager, we try to negotiate that and follow where the money's flowing in the market, because the money's always flowing somewhere. All right, so the causes of inflation have evolved since the pandemic with durable goods. These are refrigerators and cars and elevators for those people that have elevators in their home, while services and housing inflation remain moderate. Okay, now obviously housing inflation is down from where it was during the pandemic, because there are certain markets in the country, as you guys know, that are just on fire. We were blessed to be in Nashville at a time when it was really, really strong. It's still strong, but just like a parabolic growth there, and Phoenix and Austin, Texas, places like that. So while rate hikes seem to be off the table, the Fed may hold off on cuts for a little bit longer. I have a customer question, or viewer question, actually a customer too. I'd ask about this, and I will handle that in the last section. So our view here at CB3 Financial is that inflation relief has not been delayed. Well, maybe it has been delayed, but it hasn't been destroyed. How about that? So next week's CPI, Consumer Price Index, right? I just mentioned the April one. Well, the CPI for May is going to be due here in just a few days. And it's the next big piece of macro news, and we'll be watching it for you. So watch for my tweet that day. Sometimes I'll tweet twice when the initial news comes out if it really rocks the market, and then I'll comment on it the next day too. And of course, data that sparks further inflation worry will cause downside pressure on risk assets, stocks, and other things, but stocks are what we care about. While inflation relief could have the opposite effect. This is where the Fed is most sensitive to moving the stock market, and that's why I always talk about the Fed, inflation, and earnings, because that's what moves the market, and that's what moves your portfolios, and that's what you hire us to do. That's why we do it. All right. Economic indicators. This is not so much looking in the rearview mirror, which we've done up to this point. What has caused what we've done in the portfolios to happen? What have we been responding to? Economic indicators are what I'm looking at that could affect the market now that we're 5.5 months into the year for the rest of the year. And unfortunately, these are all negative. So how close are U.S. households to depleting their pandemic era excess savings? Well, estimates significantly vary. You can look on the left and you can see when people starting to save. Now, this is not March 21st, 22nd, 23rd. That's not all happening in 5 days. That's March 2020, March 2021, all right, March 2022. And you can see that savings peaked in March of 21. And since then, you can see the little blue graph there, the change in excess savings just got negative, and it's just heading down. Now, there are other data sources, so that's one. On the one on the right, their chart of the cumulative savings is just falling off a cliff, okay? Different source. You have to take all these different sources because, again, they're getting their data points from different places, and that's why I check multiple sources. And then there's this one, the cumulative pandemic era excess savings, where we reached a high of $2.1 trillion in excess savings, meaning over and above the cost of living. And now in March, just 2 months ago, probably 6 weeks ago, we're at a deficit for the first time since the pandemic. This is concerning. Do I trade on this today? I do not. I do not. My ability to predict is not nearly as important as my ability to react. So This section is me telling you how I'm getting ready to react should these things occur to any degree. All right. I wish I could see into the future, but if I could, I used to joke that I could work for Warren Buffett. Actually, if I could really see well into the future, he would be working for me. So playing into this whole concept of savings going away is consumer credit. So consumer credit, because people are seeing their savings dwindle, is not growing. Why do we care about consumer credit growing? Because 68% of the economy is the consumer. Now you could say, well, they should be spending from cash flow. Well, that's not what American consumers do. They never have. Why do you think credit card debt is so high? Why do you think personal consumer loans are so high? We're going to get to this in 1-2 screens here. You're going to see what I mean. But we're seeing no real high energy desire from consumers to add on to their consumer credit lines. And here's why. Americans now pay as much interest on other debt as on their mortgages. Bills for consumer debt service hit record highs this past year. Mortgage burden still near historic lows with locked-in deals. That's fixed rates. When we were in Nashville, we had a fixed rate of 2 5/8. Imagine if we were still there now, the bank would be hurting big time. Actually, they wouldn't because they hedge in the futures markets, but I digress. When we moved to Chicago, we got a 6 1/4 variable, which we thought was awful until you realize that they're issuing 8%. That's another question from another viewer is what about interest rates? Jamie Dimon had some things to say this past week, and I'm going to comment on that. But that's a reality here. Mortgage debt is just at an all-time high. Go back to 1978. Look at this, and it's a parabola. It's just straight up there since 2020. It can't last. What are people going to do? They're going to get second jobs. They're going to refinance if we can get lower rates. As you can see, the world wants lower rates, but the various entities, the Fed, the Bank of England, the bank, the European National Bank, they do not want inflation on their legacy. They don't want it because it hurts so many people, maybe not the wealthiest, but most of the people of any country when inflation is high, because most people don't have the ability to increase their income sufficiently to cover the increased cost of goods and services. And that's why inflation coverage is so important. So AI, we've just started this segment and I am real excited. I'm excited about tonight's episode, but not nearly as much as the next two, and I'll show you why. So I am thrilled to be able to introduce you guys to Karan Kumar, who is a senior member of the product team at Google AI. So Karan and I have known each other for a couple years now. I have been using Toggle when it was in beta at Interactive Brokers, and it is an incredible piece of software. I've shown you some screens of theirs in previous episodes. I'm going to do a few more tonight. But he'll be on the show talking about their newest iteration, which by the time he comes on in June, I'm thinking it will be out there. But even the current version is just really amazing. So this company was founded by ex-fund managers and backed by industry powerhouses like market wizard trader Stanley Druckenmiller. You guys might know the term market wizard, because that was a book or many books written by Jack Schwager. And one of those market wizards, Tom Basso, has been on my show several times and is my mentor as a portfolio manager. So it will be really interesting to talk to Karan. This is one of the screens that I receive every day talking about what's going on in this particular bit with Apple and what Apple is doing in their generative AI ambitions. Like the new Gen 10 iPad Pro, which I have just ordered, but don't tell my wife, has the brand new M4 chip, which has just billions of instruction capabilities more than the current Gen 9, which I have right now. So it's going to be very much in demand. One of the things that I really like about Toggle, and again, we'll talk about this next month. You guys come with questions. It's going to be specifically on financial advice, and I don't want to say advice, I don't mean from person to person, I mean from software to us as advisors. Vista has been a really good holding for us in CG and GI. It's one of 3 holdings in the last 2 years that I've actually had in both portfolios because it was just so strong and it met both criteria. So you can see on the right-hand side, obviously direction bullish, stars 6, target 6.44% growth. And that's from this little screen over here in February. And this is, we've had it longer than that. And you're not going to be able to take all this in. I get that. But the point is, we are reviewing literally thousands of data points, and then I screen them. You have to actually screen these because if you try to read everything that's produced by these generative AI engines, you need 30 hours a day at least, and I have other things to do besides that. But the quality of the data, like a 6 out of 8 rating here. So an 8 means pretty much you have to buy this thing, or like 100% hit ratio. And I highlighted on the right-hand side, the 3-month success rate of this is 100%. That means every iteration. Remember what AI is doing. It's going back and looking in the past and saying, well, this is what happened when this particular set of circumstances happened with Vistra. Look up at the top there. It says, well, when they had a surprise move that was more than 2%, when they had a surprise move, of 76 days where it was above 2.7%, you can decide all these different variables. And if it comes in with a really high hit rate, the chances are pretty good, then it's going to continue. And for us, that's worked really well. And those of you as investors, this is the chart on Vista. You can see we bought it back here at 31. I know it's tiny on your screen. And today it closed at 93.17, so that's a triple. All right, you'll also see a sell up there, okay? And what I do, and people, this is going to kind of go into the next segment. Why would I be selling? Well, I'm selling some of it, and that's because we always start in CG, and I'll get to this again in the next segment, with a 3% holding. But I've had to trim this stock because it would have gone up to 6.5% to almost 6.75% of the whole portfolio had I not trimmed it. So what am I doing? I'm buying low or lower, and I'm selling high, but I'm still holding a winning stock because I don't know when this stock is going to stop moving higher. It's just like that S&P earnings chart. You remember that where I showed you the parabola there? We hold stocks. We never try to predict when they're going to stop growing. We do, however, rebalance them to get to our original target allocation, which we did yesterday. Okay? Now, it doesn't end there. I'm really excited to introduce you guys to John Fountain. He's a client, buddy of mine, known him for years. He is a solutions engineer with SentinelOne, a cybersecurity expert for more than 2 decades. And as we all know, cybersecurity is nearly at the top of any industry or any company's concern list. And we have clients, some on the line right now, that work in corporate entities where security is an issue. In fact, it's an issue for all of us, but at the consumer level, it's an entirely different thing than if it's at the corporate level. So with today's threat landscape ever changing, I'm really excited to welcome John here for the July, I think it's 13th show. So I hope you guys, actually, I'm not sure when that's not right. It's the June 13th show. But at any rate, you guys don't want to miss that, okay? So the investment methodology, what is happening at CB3 Financial? So you guys remember our programs. I always start with this. I did remove Spec Op from here because I think it was just kind of confusing. There's just a handful of us that are trading it, and for most people, it's not appropriate. I am working on making this a little less volatile, although again, for the people that accept the risk, it's not a problem. But we'll be having some news on this in the November and December show because I may go live with a new program that is a little more accessible than that. So stay tuned, but these are our 4 programs for the rest of the year. Most everybody, in fact, everyone we have has a CG account. Most everyone has a GI, and those of you that like the strategies that's going on with DS, you've got those accounts too, but not our whole client base. So this is year-to-date performance. Actually, I should have snapped this after the market today. So we're over 20% on the year when the S&P is 9%. The blue line is actually my account. I blot out the numbers there, but if you ever want to see it, I'll send it to you. Just killing it, just really killing it this year. Doesn't always happen that way, but we're excited about it. So I want you to look down at the top performers. So Alpine, we're going to show you that in just a second. VST, which I just showed you, and Dell. But what I'm trying to show you here is the Sharpe ratio, 3.35. That's just a number that recommends, so what is your ratio of wins to losses, all right? And the standard deviation is how much are you moving back and forth? In other words, the volatility of the program. The lower, the better for standard deviation. 0.85 is not bad for a growth program. Look at the bottom performers. You can see those are under 1%. So many of you have asked, so what do? We risk 1%, okay, of the portfolio for position. Now you're going to see data here on the next screen that says, well, wait a minute, your worst loss was 18%. Well, but that's not more than 1% of the portfolio. It was a very low price stock. So what the stock loses doesn't really matter to me. It's what the stock loses as a proportion of the portfolio. And many years ago, I didn't know all of this stuff. Thank you, Tom Basso, for really schooling me on this. And that's why I'm as confident and as excited as I am about the next decades, with an S, ahead for CB3 Financial Program. So this is year to date. This is a trailing year. Now, in all fairness, I slipped up a little bit last year. I got a little too aggressive. I held on to some things a little too long. And so that's why I tightened up my risk management. The blue line, you can see we were doing really well in the first half of the year. Really this is a trailing year, right? So, and then we started lagging the S&P, pretty substantially there, but you can see we caught up and now have exceeded it again. So if you guys, and this is a wealth management kind of comment, but if you put your money, and you wouldn't do this because I wouldn't let you, I'm going to put $500,000 in CG. I may need to get out, $100,000 to put a down payment on a house in 6 to 8 months. I'd go, no, you won't either. Not in this program. So CG and GI, for that matter, are long-term investment strategies. There are other things you can do for shorter-term investments. So I want to review this again. So this is one of our software partners where we can run the metrics on how each and every trade is doing. There's a lot of data here, so I just highlighted the ones that are important. Look at my winning rate. It's 36.54. Let's just call it a third, a little bit better than a third. But that means that 2/3, a little under, but okay, 2/3 of my trades are losers. Well, how in the world can we make money doing that? Because look at the profit to loss ratio, 3.1 to 1. All right, that means our winners are 3.1 times larger than our losers. The biggest profit, 161%. Biggest loss, 35%. Well, wait a minute, 35%? You said you don't risk more than 1%. Let me reiterate. I don't care if the stock loses 35% as long as that's not more than 1% of the portfolio. In simplest terms, the portfolio has nothing but cash. It's $100,000. I buy ABC stock for your portfolio and it's a dog and it's gone. It has a 30% loss. What's the equity in the portfolio? $99,000. Okay. It's obviously much more complicated than that, but you get what I'm saying. We risk 1% of the portfolio. And then not only that, we ratchet up the stops. Now you can see, I'm going to go back here just to make this easier right here. So this is VST. We were ratcheting our stop. You see the little thin white line here? That's our current stop, but it's been followed all the way up from $28. So we bought it at 31. We had to stop at 28, which was 1% of the portfolio, but we just keep rising and rising. As the market rises, we keep increasing the value of our stop loss. That's just good money management. All right. That's how it works. So if you look on the right-hand side, you'll see Alpine. That was one of the big winners. And then some other stocks there that are all, 11,000, 9,000, 8,000, 7,000. Why am I showing you that? Well, I'm going to show you the losers too. So notice that my worst loss is still Wolf Camera. I don't know how I did that, but it's $2,200. It was less than 1%. And you can see all the losses after that are decreasing. Okay. So where my 15th loss is not even $1,000. How can that happen? Because the average percentage loss, look at the top there with the yellow highlight, 8% average on losers, 21 nearly gain on winners. Well, it stands to reason. I have not ever highlighted this at the bottom here, but people say, well, are you holding these winners longer? Well, indeed we are. 133 days, which is about 4.5 months, versus 53 days, which isn't even 2 months. So we get rid of the dogs and we keep the winners, and we do not, for the fourth time, try to guess where the top is. We will reallocate. We will take profits to retarget down to 3%. Every stock in CG is 3%, and it starts there. And I hope it goes to 8%, although we'll never hold it to 8%. But if it goes to 4, we'll trim it back. If it goes to 4 again, we trim it back. 4, 4.25, we trim it back. If it has a big earnings blowout where it's up 7%, probably going to sell it the next day. And you guys have seen that when there's a takeover in some of the small stocks that are in CG. So this is GI, growth in income. So the difference here is that growth in income is, as expected by its name, both growth and income. So it's 60% stocks. There are 20 stocks at 3%, and 20 or 40% in fixed income and special funds. So I want to point out a couple numbers here. So the standard deviation to the right, down the middle of the screen there, do you see that 0.52? All right, that's 40 basis points less than the deviation. I'm going to go back in CG. 85, actually that's over a year, but currently, all right, 0.92. That's a lot of swinging around. And you can see the equity curve on the left-hand side. So people call me and say, gee, what's going on? Well, CG is that way. GI is not. In fact, GI has not trailed the S&P a single day. Now, you could say, well, 2.4%, that's not really exciting. Well, it's better than the S&P, but it's not that. I get it. But you can sleep a lot easier with GI. Most people should have both a CG and a GI, and that's where financial planning and wealth management comes in, and we have a talk about that. So I've been talking about this program since the beginning of the year when we actually took it live. This is something that I traded for a while. This is the DS program, but look at the standard deviation, 1.62%. All right, that's volatile. That is definitely volatile. And it hasn't had a great year. And why is that? Because, remember earlier in the show, Mag 7 has disappointed. And all it takes is a few in the Mag 7 to disappoint. What's the biggest dog? Tesla. Yeah, it's just really had a rough time. And Apple, not really helpful either, although we had a little bump the other day. The stars, Google, Nvidia, Meta, have carried, but not enough to, make this portfolio stellar. Yet, that said, why do we keep trading this portfolio? Because of that. Because of that, all right? That's a 6.5-year track record. It'll be 7 in September. Imagine, though, if you got into this program in September of 2021 and your account went straight down from whatever, to 28,000. This is just on a nominal account, 56,000 down to 28. That's a 50% loss. So we're very careful when we have our meetings with clients as to how much we'll allow to be in this program. But you should at least be aware of it. We had a new client join us in December, came in, and we recommended to them that, if you start with 60 and it goes to 70, just take it, all right? It went to 70, and they decided not to, but that's okay. You'll get another chance. So the point I'm making is that each of these three programs has distinctly different goals, and that's the way good portfolio management is run, with different strategies, different time frames, different markets. And I'm going to answer some of this in the next question and answer, because people said, what's actually in there? And I'm going to get to that. Thank you for these questions, guys, for this last April show. You really had some great follow-up. So anyway, that's what that is. So I have talked about this in the past, and I want to cover it again because this is an equity curve, and it doesn't really matter. Just look at the shape of the line here. Start with $1,000. It ends at $18,000. And that's if you buy and hold. You make no adjustments whatsoever. But on the right-hand side, look at these drawdowns in 2001. Remember, we started in 93 and 2008. Could you stomach a 57% drawdown? Well, the answer is you probably could if you knew it was going to go back. But what if it doesn't go back and you're retiring in another year? So that is why we employ risk management strategies. So here is the same model, and notice the parabola looks about the same on the left-hand side, but it stops at about 11,000. So we start with 1,000, it ends up at 11,000, but the drawdown, okay, is about 23% in 2009. And in 2023, which is a pretty tough year, it was also tough. All right, but 23%, far, far better than 56. So what does this mean? Let's look at this and take it in. It's very easy to say you can handle a 50% drawdown if you are guaranteed a final positive result. Do you know anyone who's guaranteed that? Anyone out there has lived through a big enough drawdown period knows there are no guarantees, and it's just not that easy to keep the faith when the chips are down, and that's why we moved to cash. We did it in 2009, we did it in 16, we did it in 23, although the market jackknifed on us and we did underperform a little bit, but we made up for it. I showed you that on the charts, and it's helped this year, and we've still maintained our lead there. So in fact, it's pretty easy to lose faith, and that's why we do have risk management in CG and GI, which is the preponderance of where our clients have their retirement assets. So logically speaking, if you can stomach the big drawdowns and you believe the future will look better, then you might as well adopt the program that pays you the most. But only do that if you can handle the risk. And I mean, if you really can handle the risk. That's important. Now, you might say you just want to buy and hold because it makes more money, right? I showed you on the chart it does make more money. But buy and hold historically made more money, I get it, but that doesn't mean it's going to in the future because we have a huge variety of market conditions. And I think every one of us on this show knows that geopolitically in the world right now, we have a client that's flying into Tehran today to deal with some family matters. I mean, imagine the emotional stress in that family, not to mention Israel and Russia and Ukraine and a presidential election. I mean, we don't know what any of these factors are going to be later in the year. What we do know is the market's going up right now and we're staying invested. Past performance is no guarantee of future performance. All right. Looking in the chat, any questions? All right, so I don't know if you noticed, but I used some sound effects tonight. So a couple people have said, you need to make it a little lighter, a little more comedic. So, well, that's what I did. Anyway, this is the form you guys get on every Monday, and we had a bunch of people fill it out. It's online. You don't have to get out a pencil or anything, and just hit submit, and we'll get it, and we'll look at the questions, and we'll put them all together, and we will come up with a Q&A session like you're going to have right now. So here we go. This is from RD. Charlie, what is the target makeup for CG, percentage of stocks, U.S. and international bonds, and money market? Okay, in CG, we have 33 stocks when we're fully invested. 33 stocks at 3%. Some will go higher, and we get round those down back to 3%. That's called trimming gains. We do have international stocks. We will probably ramp that up more in 2024. But because you're at Interactive Brokers, I trade in my own account in multiple international markets, and we've had some interesting experiences in Tokyo for sure. So I want to make sure that that's debugged before I bring you guys into that. But we will be trading internationally more in CG. No bonds, no money markets. What's the target makeup for GI is the next question. Well, that's 20% stocks, 20 stocks at 3% is 60% stocks. And then 40% in bonds and what I'm going to call alternative investments. So there's one mutual fund in there. You guys know that I've been anti-mutual fund for years. But the reality is that this particular mutual fund, and I've talked about this in other shows, has commodities, international stock indices, individual stocks, international bonds, crude oil futures, et cetera. There's all kinds of things that are wrapped into this mutual fund, and it's really been a good performer, and it evens out the volatility in that portfolio, which is why we like it so much. Third question, is DS a buy and hold for a percentage of return? We do not target a percentage of return, and we do not target stops. And the reason we don't is because the stocks that are in, the stocks with a KS, that are in DS don't have stops with a PS because they're so volatile that my back testing has shown that you can stop out of an NVIDIA and it can be up 8% in 2 days after that. So the methodology on that is long-term buy and hold. If you want to call it buy and hope, you can, but I have a track record, okay? What are the target boundaries? There are no target boundaries on the upside or downside for DS. If you can deal with the volatility and you want to see that kind of return, that doesn't mean I'm going to have a 300% return the next 6 years, but that's the target. So from JP, what happens if my crypto exchange collapses? Now, this is a great question because it's a two-part question. This is also from JP. So I recently saw an ad for an alternative cryptocurrency on an electronic kiosk at CVS. What's your current opinion on crypto? Well, here's my thought on that. I used to joke in Chicago that when the cab driver started talking to me about day trading in 2008, when I was riding around and saying, I'm going to quit this in a few weeks. I'm going to have 20 grand in the bank and I'm going to be a day trader. I thought, wow, we're getting near the end of that move. So my problem is not so much with crypto, but the exchanges that carry it. So you don't see crypto offered at Fidelity and Vanguard and other highly regulated Interactive Brokers, although Interactive Brokers does now have crypto. It's the exchanges that are the problem. And the second piece of this is an email that he sent me saying, well, look, FTX, and of course that's Sam Bankman-Fried. You might know this young kid, punk as some would call him, that defaulted and literally absconded with $16.3 billion. He's in prison now. This is, to my knowledge, the only crypto exchange that has made their investors whole. And so that's a good thing. That's a good start. But to put my money and my clients' money in crypto exchanges, no matter what the actual underlying asset is, whether it's Ether or BLT or Bitcoin, is not something we're going to do right just yet. So from JB, we know that the Fed will cut interest rates at least one time before the election. Do you think further cuts will depend on who will win? So here's the thing. The Fed meets 8 times during the year. They meet in September, and then they don't meet in October and November. Well, they do meet in November, but it's the day after the election, and then, of course, in December. So those Nov and Dec meetings, November and December meetings, will have no effect on the election whatsoever. Okay, unless we're in a recount situation, but I digress. So I think we're at 1 maybe in August and maybe 1 in September, and then that could well be it for the year. If Trump is elected and the market perceives that as interest rate friendly, would the Fed back away from that and fade that, meaning not raise things when they might have, or pardon me, not lower rates when they might have lowered it if Biden wins re-election? Hard to know, but I think we're at just one rate cut before the election. From TB, when will NVIDIA hit 1,000? Well, it's at 8 and change right now. It's up 82% on the year, so I mean, we got to give this stock a little bit of breathing room here. I will say it is the largest single holding I have ever held, and it's in DS only, and I'm waiting for earnings on May 22nd. We will see, but I'm expecting 1,000 by the end of the summer, definitely this year. From JC, Jamie Dimon with Citibank commented recently that mortgages may be in the 8% interest rate for some time. What's my thought on that? I think that's a little high. My target, we're at 6.25, so I obviously watch rates. I trade the 10-year futures. I'm long 5-year futures right now. I trade the 10-year yield. So these are futures markets that bet on different directions for the interest rates. It just helps me, well, 1, to make money, and 2, to just be aware of what's going on in the interest rate and what other traders are thinking, because the bond market's bigger than the stock market, in case you didn't know that. All right. So I think 7. I think 7 is where we're gonna max out here, and then lenders want this down. Lenders are gonna, they want to see that rate lower. Builders want to see the rate lower. They want to go back to selling houses. Houses are kind of anemic right now, and it's definitely a seller's market because there's not much inventory happening. I mean, you will see some, like Toll Brothers, some builders that are doing well, but in general, it's not good for the market to have rates this high. I don't know if this is a long segment. Let me know if you think this is interesting. So when you do the survey, You talk too much during the Q&A, or I really liked it, all right? So this is from TG. You mentioned that you have no plans to keep gaining new clients. This is someone I actually met with, but they watched the show too. Once you get to your target of 40 clients, how do I know that you won't just keep growing your client base and therefore have less time for me? Okay, so the simple answer there is because I don't need to. All right? And that's just reality. There's two reasons for that. The first reason is that I'm not trying to build a book of business and sell it. I did that once, biggest single mistake of my life. Not going to ever do that again. There will be a transition plan to the next generation of advisor, but I plan to do this for quite some time. And the second reason is because most of my money I make from trading. We're not a wealth management house that is just trying to crank and crank and crank the size of their book. I trade the markets every day. This is what I talk about on the show. All right. And I trade you guys alongside me at the risk level that you've specified to me. All right. And the last one here, this is in kind of in sync with that. We are running long, but I'm sorry, guys. There's a lot of questions here. You said that you have no plans to retire. That is true. Why not? Because I love what I do. Well, what happens to my accounts when you do retire? There will be someone here in place. That's my best answer. And I'm going to put down the questions now because that's the last one. I want to tell you this story. Charlie Munger, Warren Buffett, you all know. You may not know the name Charlie Munger, although I've mentioned him several times on this show. He died at 99. 3 weeks before he died, maybe it was 4, but it was close. He was interviewed on CNBC, and great questions, good answers. You could tell he's 99. Bless his heart, he's doing great. Interviewer asked, question of the year, what's your biggest regret? And without waiting a beat, he said, I didn't become a trillionaire. And the interviewer said, there are no trillionaires. Elon Musk is decades from that, mathematically. And you're a multi-billionaire. Why would you want more money? He said, it has nothing to do with money. He said, it has everything to do with learning how to be a better investor. And a tear came to my eye at that moment, and I thought, that is my guy. That's the model. And he's 30 years older than I am. He was when he passed away. Those of us that are doing this because we love to trade are not building a business a la Shark Tank to sell. And there's nothing wrong with that. I love Shark Tank. And I'm glad there are entrepreneurs that want to do that. But that's not what we do here at CB3 Financial. This is my livelihood, but it's always going to be what I love to do. And those of you that are with me, I am glad you're here and privileged to be your portfolio manager. So that's the show. Here are the segments. Remember, next month we've got a really good AI, and the month after that, a really good AI section. I hope every section will be good for you every month. Next show, Thursday, June 13th. Be there or be square. Pretty soon after that, the longest day of the year will happen just as summer starts. That doesn't seem fair to me, does it to you? Right? So at any rate, guys, in summary, as I've said every show since we started, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. 2 Timothy 1:7. I love these gatherings once a month here on YouTube. You guys watching, and those of you that tune in, either watch it a second time or tell your friends and they watch it when we're done. Means a great deal to Alice and me. We love doing the shows. We love being your portfolio manager. We love being your educator and bringing items of interest to you. And I hope taking out the fear that the corporate media is trying to put in you. All right. We live in the best country during the best times with the best innovations. Somebody might say, don't you have new glasses? Yeah, I do have new glasses. So why do you have these new glasses? Because these are AI glasses from Meta. My son works at Meta and got me these glasses. They're actually made by Ray-Ban, but they have Facebook technology in them. So I am going to do something. Let's see who's online here. One of the things I can do is just look at my screen and send you a photo. So, hey Meta, send photo to Deb Domagowski. Yes. Now you see the little white light that went on? That's my disclosure that I'm actively doing something. And I can go up to a plant outside and say, so, hey Meta, what is this plant? And it'll read it back to me in Latin. It's just a great time to be alive. Guys, thanks for being with us on this ride. Hope you enjoyed it. Hope you feel better about your investments and just being an American. All right. Enjoy this next month. Enjoy your summer. We will see you next time, and God bless.